Hey guys, many traders get overwhelmed by too much noise on the price chart and the absence of a clear trading plan. That's why in this video we'll guide you through 3 powerful smart money trading setups. With mechanical rules that leave no space for guessing, these methods integrate core ideas from price action in smart money, such as market structure, fair value gaps, liquidity grabs, equal highs and lows, and trading psychology. If that's something you're looking for, don't forget to hit the like button to show your support. And if you're new here, make sure to subscribe and turn on the notification bell. I'll see you right after the intro and disclaimer. Let's get started. As I mentioned, these strategies emphasize market structure, fair value gaps, liquidity grabs, equal highs and lows, and multi-time frame analysis. But here's the best part. We won't be marking these manually on the chart. Instead, we'll rely on the price action toolkit indicator to automatically spot them for us. So, without delay, let's begin with the first setup. In the first trading strategy, we apply 2 time frames. On the higher time frame, we study market structure to identify market direction and align trades with the trend. This involves marking breaks of structure and shifts in character. Then, we outline the fair value gaps, which act as our ideal trading zones. After that, we drop down to the lower time frame to locate the entry trigger, which is usually a liquidity grab. Once it's confirmed, we simply execute the trade and set our targets. Now, why does this method work? By blending these 3 principles, you ensure that you're trading in line with the trend, entering at major supply and demand zones, and gaining further confirmation through lower time frame setups. Here we have a simple diagram displaying the market structure labels within the indicator. The boss label stands for a break of structure, which occurs when price surpasses recent highs or lows. A bullish boss signals bullish momentum and hints at a likely continuation to the upside. Conversely, a bearish boss indicates bearish momentum and points to a possible continuation to the downside. Next, we have the change of character, also called chalk labels. A typical bullish chalk happens when price first breaks a recent low, forming a bearish boss, and then immediately breaks the swing high that caused that boss. This creates a standard chalk and may suggest a potential reversal to the upside. Likewise, a bearish chalk appears when price first breaks a recent high, forming a bullish boss, and then quickly breaks the swing low tied to that boss. This indicates a likely reversal to the downside. However, the price action toolkit includes an additional feature. The indicator can also recognize when the market forms a lower high before breaking the bullish structure. This is marked as chalk plus, meaning it's a stronger or more confirmed change of character and provides a more reliable signal for reversal. Next, we have fair value gaps. By enabling this option in the indicator settings, they are automatically displayed on the chart. Fair value gaps highlight imbalances on the chart where a gap exists between the fair value of price. Adjusting the sensitivity removes smaller gaps and leaves only the larger ones. There's a higher likelihood that the market later comes back to fill these gaps as price searches for balance. We will use these gaps as key zones of interest, anticipating possible price reactions. Finally, we come to liquidity grabs. When applied to the chart, you'll notice green and red circles appear. These indicate bullish and bearish liquidity grabs, respectively. When price wicks above a prior swing high, the indicator marks it as a bearish liquidity grab, suggesting a possible move to the downside. Likewise, when price wicks below a previous swing low, it's identified as a bullish liquidity grab, signaling a likely move upward. Liquidity grabs highlight areas where the market sweeps stop losses before reversing direction. These signals can be highly effective for trade entries, especially when used alongside other concepts. If you reduce the pivot length and wick to body ratio, the indicator detects more liquidity grabs because of increased sensitivity. This allows it to capture smaller wicks and additional price actions that may signal liquidity being taken. Now let's break down how this trading strategy works on the chart. This setup uses 2 time frames. Our suggested combination is the 1 hour and 5 minute time frames, though other combinations may also work. Just keep in mind that your entry time frame should be at least 2 levels lower than your analysis time frame. On the higher time frame, the first task is to confirm market direction. You can do this by applying market structure principles. For instance, if price continues forming higher highs and higher lows while breaking prior structures, that signals a clear uptrend, and we remain bullish until a change of character appears. After determining direction, the next step is to identify fair value gap zones. On the higher time frame, these gaps carry greater weight and can serve as major support or resistance. Once you've marked these fair value gaps, wait for price to retrace into one of them. When price enters the gap zone, switch to the lower time frame to look for entry signals. On the lower time frame, you want signs of a possible reversal. A strong signal is a bullish liquidity grab. This occurs when price dips below a recent low, sweeps stop losses, and quickly reverses upward. If this move also breaks a short-term bearish structure, it adds confirmation by forming a change of character. At that point, it's time to enter the trade. Set your stop loss just beneath the low of the liquidity grab, and place your target at the next significant level ahead of price on the higher time frame. For a bearish scenario, begin on the higher time frame by confirming a downtrend with lower highs and lower lows. Then, mark the fair value gaps as possible supply zones. When price retraces into one of those gaps, shift to the lower time frame and look for a bearish liquidity grab above a recent high. Enter after confirmation. Place your stop loss above the liquidity grab and target the next key level below. With all that covered, always apply proper risk management to safeguard your capital. Stick to your plan and avoid emotional trading. This strategy performs best in trending markets rather than choppy ones. Keep practicing and reviewing your trades to enhance over time. Now, let's continue with the next trading strategy. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts. Manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. The second trading strategy also applies 2 time frames and merges the concepts of buy-side and sell-side liquidity, liquidity sweeps, and fair value gaps as the entry trigger. So, what do buy-side and sell-side liquidity mean? Liquidity positioned above a high or cluster of highs represents buy-side liquidity, while liquidity located below a low or cluster of lows represents sell-side liquidity. Now, what typically happens at these levels? Institutional traders, or smart money, often target these liquidity zones. For instance, if smart money intends to buy an asset, it requires a significant number of sellers to fill their large buy positions. So, where do these sellers exist in the market? We know that when price reaches a key support zone, many retail traders and even institutions enter long positions. They usually place their stop losses, essentially sell orders, just below that level. Smart money drives the price lower to capture that sell-side liquidity and trigger those stop losses. This creates enough selling pressure to satisfy their buy orders. Additionally, breaking beneath that support can attract fresh sellers who expect price to decline further. But often, after liquidity is collected, price swiftly reverses upward, trapping both early buyers and breakout sellers. The reverse logic applies to buy-side liquidity. If smart money wants to sell, they need buyers. They push price above a resistance zone, trigger buy stop orders and breakout entries, and then reverse the market downward after absorbing sufficient liquidity. With that being said, not all liquidity levels hold equal weight. Certain factors help identify stronger ones. For example, liquidity around major swing highs and lows, higher time frame levels, or areas with multiple equal highs or lows tend to carry more importance. Now here's the advantage of the price action toolkit. These major liquidity zones are automatically highlighted on your chart, showing exactly where institutions are likely to target next. This makes planning your trades much easier, as you align with smart money objectives. Now, let's look at how the second trading strategy plays out on the chart. First, apply the price action toolkit and enable the buy-side and sell-side liquidity zone options from the Settings tab. Once active, you'll see the key liquidity zones clearly displayed on your chart. Next, wait for price to break above or below one of these zones and then quickly close back inside the range. This represents a liquidity sweep or false breakout, where smart money gathers orders before preparing to drive price in the opposite direction. Then, zoom into the lower time frame and look for fair value gaps that appear right after the sweep. These gaps reveal imbalance and serve as potential entry zones. In a bearish scenario, for instance, after a sweep above a buy-side liquidity level, watch for a gap along with signs of reversal. Once confirmed, you can enter a short trade. Place your stop loss just above the sweep high and aim for the next key level or the sell-side liquidity zone below. The same principle applies to the bullish scenario. Here, we focus on sell-side liquidity beneath major lows, which the indicator marks automatically. When price sweeps this level and then closes back inside the range, it confirms a bullish liquidity grab. At this point, zoom into the lower time frame and wait for the indicator to display a bullish fair value gap right after the sweep. This gap becomes the entry zone. Open a long trade from there. Set your stop loss beneath the sweep low, and target the next buy-side liquidity zone. This straightforward process allows you to trade in alignment with smart money rather than against it. Now, let's move on to the third smart money trading strategy. This setup works with a single time frame and blends the concepts of equal highs and lows, liquidity sweeps, and once again, fair value gap entries. So, what are equal highs and lows, and why are they so significant? Equal highs and lows are price points where the market reacts repeatedly without breaking through. For example, when price tests the same high 2 or more times but fails to break higher, equal highs are formed. These levels often act as psychological zones where many retail traders place their stop losses just above the highs, anticipating a reversal downward. Smart money, however, views these zones as liquidity pools, clusters of pending stop orders where manipulation is likely. When price makes a sudden move to take out these equal highs or lows, the action is known as a liquidity sweep. This sweep often signals a potential reversal, especially downward after equal highs are taken. But what if a fair value gap emerges right above those highs? That creates an ideal trading opportunity. The sweep collects liquidity while the fair value gap provides a precise entry zone for a short position. To apply this on the chart, first enable the equal highs and lows option in the Settings tab. The Price Action Toolkit automatically identifies and marks these levels on the chart. By adjusting the ATR multiplier in the settings, the indicator can detect more equal highs and lows by accounting for wider price swings. We also enable fair value gaps and wait until all the conditions of the strategy align. A high probability bullish setup occurs when price sweeps liquidity below equal lows while remaining above a bullish fair value gap. Similarly, a high probability bearish setup forms when price sweeps liquidity above equal highs while staying below a bearish fair value gap. Keep in mind, taking more trades does not always lead to more profits. The key is patiently waiting for high probability setups and filtering out weaker ones, a skill that requires discipline and practice over time. That's it, traders. Thanks for watching this video. Improvement starts the moment you decide to take things seriously. If today's content brought you clarity, make sure to hit the like button, it really helps. And if you're just joining the channel, subscribe and activate the notification bell so you never miss a new upload. Keep pushing, keep learning, and keep setting higher standards. I'll catch you in the next